All right, welcome to Talk Tickers Explains. Today, we're digging into the latest third quarter earnings from Willis Towers Watson, or WTW. Now, on the surface, the numbers looked pretty darn good, but the stock's reaction, not so much. And that tells us there's a much more interesting story going on here.
So let's get right into it. This is the central puzzle of the quarter. You've got a company, WTW, that posts a really clean earnings beat. I mean, better than what the analysts were expecting, and yet the stock just kind of flatlined, didn't move. That kind of disconnect, that's exactly what we're here to figure out. So what's really going on under the hood? Okay, first up, let's just look at the headline numbers. And honestly, they were impressive. Adjusted earnings per share, they beat by 2 cents. Revenue also edged out what Wall Street was looking for, but here's what really caught my eye, the operational side. We're talking 5% organic growth, which is solid for sure, and a 230 basis point expansion in their operating margin. I mean, that is genuinely strong. On paper, you look at this and you think, wow, that's a great quarter. And yet, after all of that good news, this was the result. The stock actually closed down just a tiny bit, 0.17%. I mean, that's basically a flat day, right? But it was on higher than average volume. And that reaction, it's a huge signal that investors were looking right past those pretty headlines and were digging into the nitty-gritty details. So that's what we need to do now. To really understand that flatline performance, we have to look under the hood. It's not just about the numbers, it's about the quality of those numbers. What did the market see that made everyone hit the brakes? Well, if you listen to management, everything's going perfectly. They came out projecting pure confidence. You had the CEO, Carl Hess, basically framing this quarter as just another example of their great, consistent strategy in action. The message from the top couldn't be clearer. Our strategy is working. Just look at the results. But here's the thing. The market, especially the analysts on the call, they dug a little deeper. And during the Q&A session, something interesting came out. That really strong growth in their big risk and broking segment, yeah, it was helped along by what they called one-time, multi-year project placements. And folks, those two little words, one-time, that's a red flag for investors. That's what makes everyone pump the brakes. It immediately raises questions about how durable this growth really is, especially when you know they're facing headwinds from insurance pricing getting softer. So it all boils down to this one crucial question. Is this sustainable? So given this uncertainty, how is the company talking about the future? Let's turn to their forward guidance. Management, for their part, they laid out a really clear path. They doubled down on their long-term targets, basically signaling, hey, we're confident in our strategy. And here are the key pieces of that guidance. They're sticking to their guns on mid-single-digit organic growth. They're still aiming for about 100 basis points of margin expansion every year. And they plan to buy back about $1.5 billion in shares this year, which, is a really strong signal that they feel good about their cash flow. Throw in a small tailwind from foreign exchange and, yeah, on paper, it all paints a picture of steady, reliable, shareholder-friendly execution. And this, right here, this really sums up the central tension, the big tug-of-war going on with WTW stock. On one side, you've got management's confidence, right? They're pointing to their strong free cash flow and their big plan to return capital to shareholders. But on the other side, you have the market, and it's worried about some very real headwinds, things like softening insurance prices, general economic uncertainty, and the fact that it's getting tougher to beat last year's strong numbers. And that flat stock performance, it tells you that right now, investors are giving those headwinds a lot of weight. Okay, so when you put it all together, the solid results, the big questions about the quality of that growth, and what management is saying about the future, it's time for the next call. This is our take on the stock, plus an actionable trade idea based on everything we've just talked about. Now, before I give you the final rating, let's just be super clear on our terminology here. When we say market perform, we're essentially taking a neutral stance. It means we expect the stock to pretty much move in line with the major market indexes over the next year. No huge outperformance, but no big underperformance either. Which brings us to our trade idea for this quarter, what we're calling a quality of earnings pairs trade. The thesis here is pretty simple. We think the market is right to be skeptical about those one-time revenue drivers at WTW. So the trade itself? You'd consider going long a high-quality competitor, one with more durable recurring revenue. Think a company like Aon or Marsh McLennan. And at the same time, you'd go short WTW. What we're looking for, the key catalyst, is for a gap to open up in their performance over the next 2 or 3 quarters. Because ultimately, we believe the market always rewards sustainable growth over the one-off stuff. And so that brings us to our final rating on Willis Towers Watson. We are rating the stock market perform. Look, the company is doing a lot of things right. They're executing, they're expanding margins, they're giving cash back to shareholders. But, and this is a big but, those questions about whether their growth is truly sustainable, especially with all the headwinds out there, are totally valid. And that justifies why the market is being cautious, and it's why we're landing on a neutral rating.
And as always, please remember, this is not financial advice.